That's good.
Okay, right. Super films next week.
Let's start admitting. Right.
Yeah.
There we go. Morning, David. Morning, Neil.
Morning.
Morning, Michelle.
Morning.
Morning, Derek. Thanks for joining. Morning, Padraig. Let's continue to. If you've just joined, if you could mute, please, that would be great. Morning, Aaron. Morning, Ian. Thanks for joining. Morning, Simon. Good to see you again. God, 2 weeks in a row, Simon. We are blessed. Thank you very much. And yeah, Padraig, Henry, Darren, if you could mute, please, that'd be great. Morning, William. Thanks for joining, William. If you could mute, please, William, that'd be good. Hi, Ian. Good to see you. Thank you, Ian, and thank you, William. That's good. Okay. I'll monitor the lobby, I think, Henry, because there'll be a few late joiners. So, right, well, let's start. Good morning, everyone. Welcome to this week's Coffee Morning, Pension Playpen. Delighted to have our little mini roundtable session with the amazing Henry Tapper, the amazing Chris Brumford, and the amazing Bobby Ridaway. So today is really an open forum. Obviously, we want Chris and Henry and Bobby to give you their thoughts on CDC Why Wait. As usual with Playpen, we are recording. So William, Simon, Michelle, thumbs up. We're okay to record. Thank you for that. And the other thing, of course, is it's interactive. So put a note in the chat or raise a hand at any point if you want to challenge, agree, or deny what Henry, Chris, or Bobby say. So I think we are expecting Tom McPhail as well to join, but he's not in here yet. But Henry, over to you, and I'll monitor the lobby. And thanks in advance for your time this morning.
Yeah, morning, everyone. Thanks, Steve. Hi. Just to give you a little bit of background, why Chris and I turn up to these things regularly. We're thinking about launching a company which we are going to be calling Pensions Mutual, which will allow employers to control what's going on in the CDC. Okay. I say we're thinking about doing this. You need to get permission from the FCA to do a mutual these days. And we're not there yet, but we hope in the next couple of days we will be. And we obviously won't be offering CDC until at the very earliest later this year. It may not be till 2027 because we're dependent on the TPR. The TPR say it'll not be longer than 6 months between application and authorization, and we intend to apply in August. So that's a little bit of background about us. What I wanted to say, and this is not to exclude Bobby and Tom and anyone else, and indeed all of us, yeah, is that there are two schools of thought about when CDC kicks off for them. One school says we don't really want to do CDC until retirement, and we'll just offer a continuation of the DC scheme as CDC and call it accumulation or pension or whatever, and that's known as retirement CDC. And then there's another school which says if it's right, and it is as the government says it is, that up to 60% more will come from your CDC scheme than from DC saving, then why am I waiting until I get to retirement when, according to Hymans Robertson, that number falls to between 30 and 50%? Why don't I just get stuck in and fill my boots? Or in the case of employers, why don't I fill my staff's boots with better pensions, especially if I don't have to increase my contributions in doing so? So two quite different schools of thought. I think those people who say, yeah, this is an at retirement thing of those who actually want to continue to run DC schemes, and there was some recent survey work done by Corporate Advisor, which suggested that a very large number of the commercial workplace pensions, primarily master trusts, were saying if we offer CDC, we'll be offering it at retirement. Our experience talking to large employers is that a lot of employers have been fed up with waiting for CDC for the last 20 odd years and want to get stuck in as soon as possible. And I guess one of the things that we want to really explore this morning is what the views of those people who are on the call are, because it will help us whether we actually develop a product for 2027 or one for 2029, which looks like when you'll be able to actually deliver a retirement CDC plan. Okay, so I'm going to shut up and hand over to my actuarial buddies, Chris Bumford and Bobby Redway is also an actuary, but perhaps first with Chris, and then we can move round.
Cool, thanks, Henry. So I think the first part of that question is kind of what members will be wanting the retirement CDC and which would be attracted by the whole of life, and it's a great option to have both ways round, and we're delighted with all the work that's been done by a lot of the people on the call, to be fair, and the DWP on the call as well in getting those two options, making them available to members in the coming years. When we've been looking at the two different options, whole of life means that you're invested in that scheme for longer and sort of build up your pension as you're sort of employed and go along. The at retirement CDC is more sort of geared towards if you've got a DC pot and then transfer that pot across and buy a CDC pension with it when you come to retirement, and I think there'll be a good market for that when it's available, because we'd expect, as Henry sort of said, the numbers to be attractive to people at retirement when they're coming across, compared to the annuities that they might buy or the drawdown options that may be available to them. One of the other things we've been thinking about in that regard is not just the people at retirement, it's those people that are just before retirement, and whether they might prefer moving their pots before they retire and buying a CDC pension and sort of and crystallizing, if you like, the pension that they might be able to buy in a almost at retirement CDC, but just a little bit before, so they haven't got the uncertainty of their future fund value changing up to retirement, or the terms of the CDC and the price of the at retirement CDC changing beforehand. So it may be that some people might want to transfer some of their pot slightly earlier, get those kind of guaranteed, well, I shouldn't never use the word guarantee, should I, with the CDC, but get those terms that are known at today's date, and maybe have that pension known a little bit earlier, without, like I say, without the uncertainty of the future years to retirement and the future pricing at retirement. So yeah, just wondered if anyone had any thoughts on that, and that.
We've got a call coming in from Billy Burrows, and this is one of the most commonly asked questions, and I know it's one that you got an answer to, Chris, so I'm going to ask you this, and I'm going to go on to Bobby and Tom, who's also on the call now. But how does CDC differ from with profits? That's Billy's question.
Cool. So I mean, I think it depends which type of with profits, because you sort of obviously got with profits investment funds and sort of with profit annuity type things as well. But I mean, the key difference for CDC is that you're getting a pension, and none of it is guaranteed. So the assets in the scheme always equal the liabilities. With a with profits fund, if it's invested investment fund, then you've kind of got your investment that you might sort of smooth the benefit, or smooth the increases or the returns over time, or might be have some level of investment that is sort of tried to be kept more secure, if you like. With the CDC scheme, all the assets always equal the liabilities, so there's no danger of ever falling below the liabilities. They just move up and down, so you're getting a pension, and the experience of the scheme is spread over the future life of all members. So if your experience is good, then that sort of looks like higher increases in future. If your experience is not quite so good, then that looks like slightly lower increases in future. But all increases is spread to across all memberships. And if in extreme cases, if experience was very, very bad, then it's possible that the benefits can be cut under a CDC scheme. Whereas under with profits, that would be slightly more. It's a slightly more kind of average and a smooth approach, and it isn't necessarily based on pension. If it's an investment fund, that with profits and annuities would have a more guaranteed element to them.
This is bringing me on something else. Now I'm going to spread this around to Bobby and to Tom in a second. But one of the things we've had a lot of conversations with people about, and they include that great actuary, Mr. Andrew Young, who's I don't think on this call, but if he is, hi, and that is how much by way of increases you should be giving to people, and to what extent this is going to impact their initial pension. Now, if you say we're going to pay CPI plus 1 or even 2, yeah, then it comes at an expense. So you're going to have to pay an awful lot less to begin with, but you will be paying, much greater increases. If, on the other hand, you just pay CPI, you'll be paying a lot more to begin with, but there is always a danger that you may find yourself having to reduce your pension year on year from time to time, and more often. And there are two schools of thought on this, and I'd be interested, if I can pass this to Bobby, in your view. I know Chris's view and his view and whatever, and we are not set in one way or another, but we're interested in hearing from others. So you, Bobby, you're on at the moment. Do you want to take yourself off and give us your view on whether you'd rather see high increases or low increases?
I think it will come down to what people prefer. If you price for high increases, then you're less likely to have to cut the fixed benefit. If you price for lower increases, you're going to have to start up with a higher fixed benefit, and there's more likelihood that you might cut that benefit. To come back to how this differs from with profits, in many ways it looks very similar. If anyone's familiar with profits, which I was a with profit actuary, so I'm very familiar with profits, what you get provided is a guaranteed amount. And then every year you got what was called a reversionary bonus, which increased your guaranteed amount. And then what they did with profits, which CDC won't do, is they ran investment risk that they expected to come up with a surplus. And at the point at which you had paid your benefit, they wrapped that up in what was called the terminal bonus. Now, CDC is the same in that you get a fixed amount and you're promised an increase on top of that. It's different in neither of those two things are guaranteed, and it's also different in that there's no roll-up and you get a reversionary bonus at the end. The real positive I see from CDC is the fact that you go tomorrow to purchase your first CDC units, you know what pension that's going to give you at your retirement age, pretty much. And if these schemes do what they're set up to do, then the increases might be different. but you see a pension amount, and you can work out if you pay a certain amount per year up until you retire, roughly what that's going to give you in pension. And to have that priced on a fair market basis is unique, because up until now you have to price that in the insurance market, and this is a unique opportunity that we need to make the most of and protect it from regulation that comes in and starts turning some of these things guaranteed. The real killer for CDC would be if the regulations and the government decided to say either that initial pension or the increases were guaranteed, because that would then turn it into an insurance model and back into with profits, and it would kill investment and everything.
But you see, I mean, I will just drag into the conversation John Quinlan here, a true insurance man and someone who has been involved in with profits annuities. And you have something to say there, John. Do you want to sort of, I know it's in the chat, do you want to sort of say it out loud?
Yeah, okay. Thank you, Henry. Yeah, I'm a true pensions man and insurance man, Henry. So both. The with profits of today is very different to, Bobby. You're right about the profits of old. They're very different today, and the comparison, it would be a sensible thing to compare the asset mix and asset performance of the current modern with profits versus CDC. They have a major advantage, actually. And the major advantage is
So
they have got
which has an advantage over which?
with profits.
With profits has an advantage over CDC.
Yeah, I mean, if you look at the productive capital allocation in the proof fund, for example, and I'm not a flag waver for proof fund, but it's with return seeking, and in terms of getting stuff off the ground, it has a major advantage. It's got a big capital stack. So I really think it's worth doing that comparison rather than doing certainly from a starting point. That is a challenge, and there's the guarantees in there are frankly minuscule now. So it's a much more of a smoothing mechanism. So actually the techniques that they will use would be very similar, I suspect, to a CDC when you start with a higher initial pension, smoothing up and down.
Yeah, and I can see situations where people will look at the with profits fund that is offered by the Prudential, the M&G sort of basis, and say, yeah, well, we could use that, and we could run a CDC scheme with an investment strategy based on that. Do you think that's possible, John?
Yeah, I think it is. It certainly is, and it's actually not. I mean, with profits used to be the art of the complicated. It's now much more straightforward for people to understand. Frankly, I'm not a flag waver. I just think that it's a mark to model solution, and frankly, CDC is mark to model. So, and the mark to model world should look at the other mark to model guardrails and guidelines and governance.
And what do they typically provide in terms of a benefit, John? When you buy the with profit,
if it's a fund, it's a fund. You know, as you know, Bobby. But if it's a pension, then it's much more akin to the CDC starting from a low base.
Okay, that's very, very useful. Okay, Chris, you about to say something here? I can see you.
Yeah, no, I was just going to mention that I think when we talk about smoothing and the sort of and how the experience is spread, I think there is a difference in there, because under CDC it would be spread over the whole future life of all the membership, all the current membership, which is probably a bit more difficult to do with a with profits kind of.
It's not no. It's actually, I mean, in terms of they're not what they're not doing. They are looking at they're looking at the current position rather than presuming that the assets necessarily going to recoup. But it's very similar, Billy. It's very very similar, Chris.
Okay, so we're in a space, but I want to keep a kind of conversation, if I can do, focused on the three topics which we've got today. One is, should I be running my life around DC to retirement and then moving to CDC, or should I be whole of life CDC, sorry. Secondly, do I want to choose a CDC scheme which goes for lots of growth, or do I want one which is going to give me a high income initially and maybe not such prospects of growth? And there was a third question which Chris and I have had coming up a couple of times in discussions with people this week, which we thought we'd share with you, which is that of people who are in CDC having a dependence pension, so that if they die early, their money goes on to somebody else. I'm not going to throw that to Chris. I'm going to ask Tom Fail, who I know is on the call, especially he's lurking somewhere in the background. But Tom, if you were in a CDC scheme, I'm not suggesting for one moment that that commits you to being in a CDC scheme, but if you were, would you want Mrs. McPhail to be a pensioner in the event of your early death or not?
I think she'd be disappointed if I said no to that question, Henry. So yeah, I think one of the problems you're going to bump up against with this is where we've got to post-pension freedoms, where there is now this context of my pension savings, my DC pension savings are an asset, much like my pot of ISA money or my house, and therefore I factor that into my financial planning, and that includes provision for my dependents. So if we flip to a world where my pension assets stop being an element of my overall accumulated wealth and become instead an entitlement to an income stream, you've then got this conflict between that income stream on the one hand and the seductive siren call of pension freedom world on the other hand. Now, Rachel Reeves has taken steps to undermine that with the inheritance tax changes on DC pots. But you've got to reconcile that conflict, and particularly if you're allowing people to make that decision at the point of retirement. So if on the one hand it's drawdown with death benefits versus CDC without, that's a pretty invidious choice you're asking people to make. I'm also concerned about, for retirement CDC, how you manage the underwriting question at the point of entry, which I think is unavoidable. I mean, there are actuaries on this call who can give a more informed opinion than I can on this one. But how do you work around that selection risk? So yeah, I'll pause there.
Of course, any actuary who wants to butt in can put their hand up and join the conversation at any stage. And I know we've got a lot in here, but my friend Mr. Bunford has got his phone, his mic unmiked. So do you want to jump in here, Chris, and give us your view?
Yeah, no, happy to. And you're quite right about the underwriting, Tom, and the nuances and difficulties around that. I don't see it being any more difficult than for existing annuities, to be honest, because existing insurers will not want to be selected against and price things according to individual members' health. And we had a little chat about that last week, and sort of the mortality sort of look and how that could change for various people. So you could, I think it's a more relevant conversation for at retirement CDC. Whole of life CDC at younger ages, people tend to be a bit more homogenous a group, but there will be outliers in there, and there will be people in ill health, and you may wish to price things differently for example, people with higher incomes expected to have higher sort of longevity and live longer there. So I think it's quite similar to the annuity market at retirement, in terms of the amount of underwriting that might be done. But for whole of life CDC, especially if you're in one sort of a section with one employer, I wouldn't expect so if there was a Section 1 employer, I wouldn't expect there to be underwriting for that. If there was several employers, you could either have it in different sections if you thought their experience was going to be vastly different, or you could potentially do underwriting on that. In terms of the spouse's question, the spouse's pension itself, or the dependent's pension, sorry, that's likely to be payable. You can imagine an at-retirement CDC scheme wanting to sort of have that information, and for members who didn't have a dependent not wanting to have that additional benefit. I think traditionally in sort of DB schemes, which are sort of more similar to a whole of life CDC, members don't necessarily have a choice. They get given a dependent's pension, and it's payable if there is a dependent, and it isn't payable if there isn't. And because in whole of life people aren't necessarily going to know what their situation is at retirement, and I can imagine for several employers wanting to include a dependent's pension for all members in a whole of life CDC scheme.
So can I come back in on that, Henry? Chris, thanks for that, because one of the things that's just been gnawing at the back of my mind through this whole, not just this morning, but this kind of contemplation of the CDC proposition, is the communication around it. And I think back to my Hargreaves Lansdown days and the challenges we had in communicating at a retail level, the nuances and complexities of with-profits. And you know, some of those same challenges will manifest themselves in terms of how we talk to customers, members, call them what you will, about how CDC works. And something Henry and I discussed recently is in particular how we reconcile the complexities of the cross subsidies inherent in CDC, and how we communicate that at a retail level, which can get challenging. And then I just my final thought on this is where this takes me, and I'm scarred, as maybe some others on this call are, by recently working my way through CP 2539, it's the FCA's latest infliction upon the industry around digital modelling and transfers, where they cheerfully acknowledge that they're introducing another regime on top of COBS 13 and SMPIs and annual benefit statements, but what the hell, we're going to do it anyway. and the increasingly complex regulatory landscape and the friction that exists between TPR world and FCA world, where CDC sort of lands halfway between the two. So I'm just going to reiterate my hobby horse that, you know, if you want this to work well, first of all, you need to go away and actually reconfigure the regulatory landscape and ideally get rid of at least one of those regulators. And so I've gone from communication to cross subsidies to regulatory reform, and I should probably stop at that point.
You can carry on, but I think you run out of breath because there's so much thinking going on there. I'll come back on one point here, and that is the simplicity of it. I'm 64, and I'm at that point where I am about to take decisions about what I'm going to do with my money, and it's really hard. Yeah, and I think this is one of the things that the whole of life just takes you away from. Yeah, because effectively in a whole of life world, you don't take any decisions, they get taken for you, and you may want to opt out and take a transfer. That's your choice. But for, say, 90%, maybe more people, they'll simply run on and get paid a pension by default. And the question we were originally with is, would their spouses, partners, dependents get paid a pension as part of that deal? And I think it is fair to say that you wouldn't need to choose, you would just have one of those paid to you if you had one, and that's the way things go. And I think that may well be where we end up with regard to dependents. So you don't choose one, one's available. If you haven't got a dependent, then that's unfortunate but it's not unfortunate to you because you're dead, right? And it's only occasionally that we'll get into a situation where we'll have a dispute, and the trustees will have to sort that out. They have to have good rules. We've been through all these things, but that's where we're at. If, on the other hand, you're buying into CDC at retirement, then all these kind of decisions are decisions that you have to really take, because they're there. It's much like buying an annuity, and I think it's going to be a different type of decision. So one of the things that we've sort of come up with is a world where you don't take an awful lot of decisions, and that's the whole of life world, rather than a world where you do take decisions, which is kind of like guided retirement, which Richard Smith talks about a lot, and there was supposed to be debating just last night at, or was it Monday night, in the Lords, but never quite got round to it, so they're doing it next Tuesday. Do we want people to be taking those decisions? Are we wanting to be in a retirement world, an act retirement world? Do we want it to be retail? Or on the other hand, do we want it to be collective, whole of life, and not something where you take a decision at all? And I think that's really what we've got to make a decision about if we're employers. Do we want to be making decisions on a whole of life basis and operating a pension system, or do we want to offer pensions as a choice, which is the retirement world? Does that make sense?
I've just got to go now, but I just want to make one point on Tom's. I think the thing we're seeing is we're minimising cross subsidies. It's going to be things like this where you say, if we just provide a dependent pension to everybody, then that means the actual cost of providing that is spread across everybody. So in a way, that is a cross subsidy, but it's saying it's sensible to group this amongst this group of members, rather than cross subsidies where you have multi benefit structures and different ages and stuff. But some of the horrible cross subsidies you see in some of the bigger arrangements. So I think the things with CDC is any cross subsidies should be identifiable and explainable, because they're not necessarily cross subsidies. They're just ways of spreading the risk across a reasonable number of members who should be able to share that risk. Anyway, I've got to go.
Okay, Bobby. We seem to have had a dispersion of members in the last 30 seconds. I don't know what we said. I hope it was nothing rude. We haven't got the yellows up. If anyone wants to ask a question, now's a good time. Okay, well, right. We have got 2 questions up, so let me just have a look to see who they are. Who's one?
Peter Cameron Brown, then JQ, then Billy.
All right.
Peter, do you want to go first?
Much. Peter.
Yes.
Peter, you first, and then John. Yeah.
Right. Yeah, just picking up on that point. Coming from a DB background, I see whole life CDC as a quasi-DB arrangement. It's chosen by the employer for his employees on the terms, and just as in DB, the employer determines what benefits are provided under the scheme. The difference being, of course, the ability to change the outcomes depending on the investment performance, but that's not under the employer's control. And that is quite different from the individual approach to DC, where you're thinking about individual wealth for an individual, and you're comparing it under various alternatives and what is the best result for that individual. When you get on to talk about retirement only CDC, it is effectively just a quasi annuity in terms of the decision making from the individual. Is it better getting a CDC pension paid, or is it better having annuity? And there it becomes an individual decision, and the factors is that you match that to the individual circumstances of the member rather than as a group concept. So That to me appears the distinction. The one thing I'm worried about with whole life CDC is the retention of reserves, in either directly or indirectly, in terms of the assumptions being made about the benefit accrual, but that's a different issue.
Well, we'll come back to that. I noticed that Derek Benstead has made a couple of comments in the thing, and he might want to comment on that as well. So we've had lots of conversations in the past about that very issue. But I've got John on the call. And John, do you want to say something now?
It's just fairly quickly. I mean, we should learn from what the POA and FCA do. The POA regulate the prudential element with profits, and the FCA regulate the conduct. And the question I mean, with all of this, the design issues impinge very quickly into both of those worlds. And the question I have is whether the TPR is the right home for this, full stop. And I know it's a really big question, but I think until that's answered, the design questions are secondary.
So, do you have a hunch? I mean, do you want to say what the Quinlivan view is?
No, I'd have no. I mean, I think the fact that there isn't a view probably points to why CDC, or one of the reasons why CDC may not have moved forward as fast as it could have done. Is my instinct.
I think on that, we're looking at a trust-based system at the moment, rather than retail, which is why it sits with the pensions regulator. I think if we get to a retail system where individuals are buying CDC pensions, then it may well be regulated sort of more in line with insurer annuities at the moment with the FCA.
Chris, I'm going to jump in there quickly. Thinking back to what Peter was saying, doesn't a retirement CDC effectively compete directly with drawdown and annuities? So don't you have to regulate it under the FCA?
So yeah, when I said the current position, I meant for whole of life CDC that is coming out first, and then retirement CDC is coming out in a couple of years later, and I would expect that to be more retail for individual members.
I hope we're having the conversation which the DWP want us to have, which really is about order and time schemes and so on. And Julian, you're free to jump in if you want, but we'll leave you on the side for the moment. I've got Billy up next, and then Ian McIntyre. Billy, do you want to ask another question?
Yeah, I'll be very quick. Henry, I think you sort of perhaps misunderstand me. So first of all, I'm a great believer in CDC, and Tom's made some very good points. And where I come from, and sort of two relevant things. First of all, I was an expert witness in the mis-selling of with-profit annuities for equitable life. And so when I asked the question, are the risks being explained and understood, there's a really serious issue here, because the experience of equitable life is, at the end of the day, nobody understood the risks, even though they thought they did. And I think sort of my contribution to this, and I'm in line, with Tom and all of this, I'm like a record here. When you come to retirement, there are only two ways of taking money out of a pension pot, converting it into income, some sort of annuity, some sort of drawdown. And I believe passionately that everybody should be given all the options and given as much help, guidance and advice as they can. And I think, the bit that I struggle with is how people are actually going to get unbiased, informative help in making what is, one of the most difficult decisions in financial planning.
Well, yeah, and the alternative is not to give them that decision and just get on and take it for them, which is what the whole of life does. But thank you, and I'm going to come back. If you want to ask another question, I'll come back to you. But I do want to hear from Ian.
Hi, Henry.
And then I'll speak to
welcome.
Yeah.
So many of you won't know me so much. I'm not an actuary. I'm nowhere close to actuarial stuff. What interests me is in a CDC market where it is competing with DC and existing pension arrangements, what will happen when a member's only got 2, 3, 4 years in a CDC and the rest of their benefits, the rest of their savings are in a DC, which I think will be very common. What does a transfer environment look like? I'm not sure that I, as an individual, would be that interested in 2 years worth of CDC. I'd be looking to transfer it, or others may take a similar view. How will that work? It's that kind of administrative burden, and also something close to my heart: small pots. What happens when a CDC, the benefits are very small? Will that be subject to small pots regime? That kind of question as well.
Yeah, well, your question is, can people take money away from CDC into their nice, glorious DC pots? And I guess there might be other people who think it's the other way around, the direction of whatever. Do you want to comment on that?
Or between multiple CDCs. I've got 3 different CDCs, let's say. Is it worth me transferring into one of them? Consolidating, for example.
Do you want to comment, Chris?
Yeah, I was just going to say, so transfers out and transfers in should be perfectly possible. They'd be done on a best estimate basis, so there shouldn't really be margins in there. So I think someone mentioned earlier about possible margins and reserves built into the assumptions. If you do that, then you start to favour one group of members over another. So the sort of whole. Yeah, no, absolutely. So the whole point is that it's done on a best estimate, and those margins are kind of removed. That's not to say the basis for members selecting to take benefits out will necessarily be the same as the bringing in, but it will all be done on a fair best estimate basis, and there should be no difficulty moving money in and out before retirement. Once members have retired and reached their normal retirement age, that becomes a little bit of a different question, and the selection becomes harder. So they may not have the statutory rights to transfer once it's in payment.
And as a follow-up to that, so is the money available? So one of the great problems we've got with transfers at the moment is they take ages, and the regulator wants them to take a lot less time. Is the money readily available? Can you be doing it in hours, in theory? Or do they have to? Are we having to withdraw cash? Or cash reserves have to be there in order to facilitate transfers? That kind of question.
Yeah, so it would be fairly similar, I would think, to the sort of current DB regime. A calculation would need to be done. We're imagining CDC schemes having those systems in place to do that quickly, rather than having to wait weeks or months for a quotation.
Which is interesting because the current DB regime is shocking, in my opinion. The amount of time it takes to get a transfer value, let alone an actual transfer out of.
I totally understand, Ian. I think one of the things that's happening at the moment is that a lot of you look at the likes of one or two of the more modern administrators, and they're moving into an AI-based administration system, which is a hell of a lot quicker in terms of timeframes. So the hope is that we'll start seeing pensions moving around the system quicker. And when you see some of the people who are involving themselves now in the small pot environments, and I'm not going to mention any names, but I can tell you for sure that these are people who spent a lot of time at places like Oxford, Said University or business school, like finding out about AI. I think that the breakthrough in all of this stuff will be when we adopt AI and get things moving at the kind of speed which everything else does. I mean, when I think about how decision making is taken with regard to my bank, it is simply a flick on my app which validates things, and I get on with them. And that's what I'd like to see happen. But we're into a whole new area here. But that's the aspiration. It's our aspiration. Yeah,
Henry, everything the FCA is doing will make transfers take longer. Just putting that out there. They're deliberately trying to slow everything down even more. They're not solving the problem, they're making it worse.
Oh my gosh. And Billy Burrows is another expert, and this is shaking his head. And Ian, are you shaking your head too?
Oh yeah, absolutely. Yes. The FCA says transfers should take less time and have far more security around it, so the process should take longer. Yes. That is the reality of transfers at the moment. But also your point about the application of AI and the application of technology. To be honest, that technology could have been applied 15 years ago and wasn't by the industry. So I wait.
We still don't even have electronic signatures. I mean, you know, there's simple steps that could be taken to make things work faster. And so you can't hate the FCA enough.
Okay, sorry, I have to actually obliterate that particular comment. Are we recording? Yes, we are. It was him. I've got Derek on the call. Are you still there, Derek?
Yes, Henry.
I'm going to move to you now, please.
I put my hand down because I didn't want to interrupt the conversation abusing the various regulators, which I think is well deserved, and all in favour in reducing the volume of regulation and the number of regulators so we can all get on with providing pensions better without interference from regulators who only ruin things. That isn't what I put my hand up to say, but,
but you
it's
said
far too tempting to wrap up the conversation that Tom and Ian and Billy were having there. The contribution I want to make, given that some of the conversation covered my points before my hand got to the top of the queue, I just want to wheel back to transparency of CDC. A key principle of CDC is that its management policies and actuarial evaluations must be published on the internet for all to read. And my hope is that this will keep CDC management honest, that if there's a critic with a valid criticism of a way a particular CDC scheme is being run, they'll have the opportunity to see data, see documents, and make a valid criticism that the trustees and the scheme actuary might then take heed of and help keep schemes well run. I well remember when I had the misfortune of being an endowment policy holder, maturing after many of the demutualisations were done and after the period of overpayment of with-profit payouts, minimising my with-profit payout when my policy matured, that notwithstanding I was an actuary trying to find information on how my with-profit fund was being run and how those decisions were being taken, you just couldn't find it. We have some with-profit actuaries on the call now. They might jump in and say, but modern with-profit funds are run properly and you can tell what is going on. You certainly couldn't tell when I was a with-profit policy holder. So we've had lots of discussion around CDC in this call and last week's, none of which explicitly mentioned transparency. And transparency for me is a key CDC principle. It's one of the things that I made sure was present in the Royal Mail design and the CDC regulations, all the conversations I've had with the DWP and regulators. I think it's vital. So I'd be very happy to hear other people's comments, especially with profit actuaries' comments, to see if they can either concur or disagree or say modern with profits works or whatever.
Derek, you have just got yourself a job, and that job is with Pensions Mutual, making sure that everything we do is as transparent as you would like them to be. Thank you. Sorry, Chris, I've just landed you with Derek Benstead on your back, and that's a monkey and a half.
Absolute pleasure.
Thank you very much indeed, Derek. That was beautifully put. Has anyone got any comments? Yeah, Steve Goddard put his hand up. Steve, how are you?
I'm well. Yeah, just a thing in the back of my mind. Obviously, I think you talked about transfers in. Presumably, if somebody's in retirement, can they do, and they find some more pots through the dashboard, they can transfer more money in, I assume. Yes?
Yes.
No? Okay, which is good.
You want to buy some pension?
Yeah, just want to buy some pension.
Yeah, okay.
You've already got one. It's £2 grand a month. Will you then get £2.5 grand a month because you transferred another X in? on top of that. So you will allow, or generally allow transfers in post-retirement is question number one. And question number two is, if you're running a scheme, but they haven't been part of the employer or the master trust, will you accept virtually retail customers? I.e., hi, I've got 500,000, I want to join your scheme post-retirement. Will you accept retail style customers? Henry, Chris?
Yeah, you're talking here about retirement only type product decisions.
Correct.
My initial reaction, and my partner sitting beside me has just used the same phrase, you're talking about a retirement CDC product. Now, I would imagine that most whole of life CDC providers, if we can use that phrase, if we have a number of whole of lives, will almost certainly want to be retirement CDC providers as well, because they'll have the systems and everything right there. But if they don't, I'm quite sure that other retirement CDC providers will be out there to do that job. Is that your kind of answer, Steve? Does that make sense?
Yeah,
to
no,
you?
that's fine. I mean, it does conjure up, and maybe Tom's got a view, but it also then conjures up, if you're an IFA, and Billy will know this as well, if you're an IFA, what are you going to do then? Are you now going to trawl, or will there be hubs which provide, guaranteed annuities, and then there'll be a hub for CDC providers? Billy, am I correct? Do you think that's got to happen, hasn't it? Otherwise,
obviously,
otherwise,
I mean, that, Billy.
IFAs be screwed to say, oh, you didn't concede CDC, and I could have got a bigger pension, and you didn't do your job right. That's exactly what the FCA will say. But, go on, Billy.
But I'm with you. In fact, I'm in the middle of actually just typing a reply to that, saying, people do need advice, and I don't think I'm wrong here, where everybody at retirement should start off with a clean sheet and an open mind, work through the various options to work out what is most suitable for them. And I get it that some people have got small pots and you can't do it, but if we're serious about making sure helping people get the right outcomes at retirement, then they do need to consider all of the options. And on that specific point, if you had £500,000 and we're looking to transfer into a CDC, boy, would you need some good advice. And I don't know if there's many people who've got the experience and the qualifications to give that advice in the first place.
And Henry, this is a can of worms. I'll tell you why. Because that £500,000 member might be in your scheme, and he says, "Oh, actually, I want to transfer out to another scheme because they've offered me £2,000 a year more than you're offering me on a post CDC." So you've got to be prepared to give up that member, give up that asset, and transfer it out. Would that be allowed, or are you saying actually transfers out won't be allowed after a certain date? Or I'm just asking the question.
Yeah, we've got questions coming in left, right, and centre. But Chris, I'm going to give you a chance to answer there because I know you've got a good one.
Yeah, so I think we need to be a bit careful about sort of running before we walk on this sort of stuff. And the reason that everything's been done sort of in a trust-based environment, and Julian's on the call, so please do correct me if I'm wrong. But the reason it's been done on that basis is that we don't want to initially get into a competitive industry environment where assumptions are made and people can manipulate the actuarial assumptions made to make their product look better. At the moment, the initial stage is employer-led CDC schemes where their members are going in and getting a better financial outcome from that. And we would love to move to a situation where people can start to choose the CDC scheme that's right for them and move their money across. But it's a very different environment when it's a competitive. You've got 5 different CDC choices at retirement that could be making different assumptions. You need to make sure everything's consistent, the benefits are understood and consistent. That's a very different world to one where members are going into employer-led schemes and they aren't just moving their money, choosing where to go. So the whole of life schemes we're looking at the moment are trust-based, and members are being encouraged by their employer to go into them. It's not so much that they're picking and choosing and being sold a product for themselves. That makes sense.
Okay.
Okay.
There's some interesting questions in chat between Ian and Julian and so on. I'm going to come to Julian, then Tom, and we're going to be wrapping up in 5 minutes.
We got JQ and Tom's hands up as well.
Yes, that's what I was saying. Jay, if you can make them quick, we'll get on with them. John.
Okay, very quickly, if we end up in an assumptions war and a features war, and we've seen the features war in variable annuities in the States, CDC will fail dismally.
Can you explain what you mean by a features war?
Features war is when the benefit structures for different providers have got knobs and whistles on to try to gain market. And it becomes incredible. I mean, the beautiful thing about an annuity is it's simple. You get paid an amount of money until you die. You know, it's kind of, and they're 5-year guarantee or not, and spouses or not, pretty straightforward stuff at one level. In terms of the product, if you look at what's happening in the States, the features that they've added on to all sorts of structures means it is a hell of a job for people to understand and to give advice on as well, and to regulate.
That's lovely, and makes the cut point I was making less well earlier, which is whole of life is institutional, is corporate, and is simple, and you don't get an awful lot of choice. If you move and leave it into retirement, then you're in retail, then you've got complexity, and it's much harder for individuals. But that might be what you think is the right thing to do. Give people a lot of choice. Do you agree with me, Tom, or do you think I'm talking rubbish?
Henry, you never talk rubbish. So just very, very quickly, I really agree with a lot of the comments we've just heard. I guess the paradox is the use case is compelling at retirement, you know, we've heard this from the DWP over the last couple of years, a way of eliminating the longevity and investment risk at retirement and giving people asset-backed returns whilst eliminating the longevity risk. You know, what's not to like about that? So if ever there were a use case for CDC, it's at retirement, right? I mean, whole of life too, but yes, at retirement. But as we've just discussed, you bump into a whole series of problems as soon as you start selling it on an at retirement only basis. And I think it would make the at retirement. I mean, think about the complexities of investment-backed annuities we had a few years ago, which were a great idea in principle, but you know, bumped up against a whole load of problems. It would make the retirement decision-making process, as has been alluded to, quite a lot more complicated, whilst also becoming more enriched. So I absolutely agree with the point made. Let's start with whole of life and sort of build slowly from there.
Thank you very much. And I will almost want to end on that note, because that's a beautiful one. But I just wanted to comment with a comment from Peter Cameron Brown. Could I, at the age of, say, 55, you know, put in a contribution from another place into a whole of life plan and get paid an extra pension at 65? And I think the answer to that question is, Chris, that yes, you could. Yeah.
Yes. Sorry. Yes. You could. After age 65. I was distracted. I got the vision of Julian appearing on my screen, and I know he wants to say something. So I was just about to pass across to him.
As you alluded to view, you put your hand
up. As if by somebody rubbed the lamp.
Julian, if you want to ask a question.
No, I don't want to ask anything. I just wanted to just thank everyone for another fascinating conversation, and I think, you know, a lot of what people have been saying are the things that I and my team, you know, struggling with every day to try and make sure that we, you know, create an environment where hopefully CDC can flourish, but avoiding the traps and things that we have just been talking about, without obviously creating so much regulation that Derek gets upset about it. But you know, that's kind of what our day job is. I mean, and you know, I think there's some really good points made at the end there about, you know, the difficulty of you know, trying to open up a pure sort of retail market. And I wouldn't say that that's something that we're not going, you know, that we don't recognise the value of, but it's not something we're going to sort of leap into blindly for the reasons that I think people have sort of brought out.
even though you're getting beaten over the head by the pensions minister for not having it as a retirement option for people as they leave their workplace pension. Not.
So, sorry, what do you mean?
Sorry,
The guided retirement? You mean the guided retirement?
Guided retirement. Yeah.
Well, we are doing what we can and making as much progress as we can, and things are moving and developing both in terms of the outcome of the consultation that we did on retirement CDC just before Christmas, and the work that's obviously going on guided retirement, which is likely to get debated in Lords Committee probably next week. I think
next Tuesday. Next Tuesday, the 3rd.
It depends how long they spend on scale and asset allocation.
Well, all of that to come. Exciting. We've now passed the magic hour moment, so I'm going to have to pull things together and say thank you very much to everyone who's still on this call. It's been beautiful, as Donald would say. It's been a beautiful debate. Chris, don't laugh at me. Thank you very much, Steve. Can I hand back to you, and you can do?
Yeah, just to say thanks to Henry, Chris, Tom, and Bobby earlier. I hope you all enjoyed today's session. We'll put the video up. I did say Tom.
Yeah, right.
Yeah, thank you.
Sorry.
And yeah, great session. And Julian, there's a lot of industry practitioners on these events. If you need, to get us in a room and beat us up one day with a cup of tea and a biscuit, I'm sure we'd be delighted to help and attend. But there's a lot of talent on these calls, and the government, the DWP, should use it sometimes.
Well,
so,
I'm pleased to say, I'm pleased to say there are many people on these calls who I and my teams sort of talk to pretty much on a daily basis, and CDC wouldn't be where it is today if it wasn't for the time and energy that's been brought to this from many of the people who are on this call. So
thank you for your comments. That's really kind.
Thank you, everyone.
Brilliant. Thanks, everyone. Well, enjoy the rest of your day. Enjoy the rest of your week. And cheers, Henry. And there's peace in the East.
Thanks to all of you. I know who you all are.
Cheers. Bye.
All right, take care.
Bye-bye.
Everyone.